Hello and welcome to another video on my YouTube channel. My name is Joris, and in this fourth part of my series about how to evaluate a stock, I'm going to give my future PE valuations for my estimates of the future growth rate of a company. So as you know from the previous videos, when you have already watched them, you should go and watch them if you haven't already. So I'm giving my interpretation of the formulas of Peter Lynch and Benjamin Graham. And when you start from the formula of Peter Lynch, then my simplification of his formula is that you can take the future PE of the company divided by the current PE of the company, and then you can deduct whether or not the stock is buyable, yes or no. And the future PE of the company, when you use the old formula of Benjamin Graham, you can change that out by 8.5 plus 2 times G, and G is the future growth rate of the company. Or with the new formula of Benjamin Graham, you can change out the future PE by the formula of 7 plus G. But what is then my estimate of the future PE out of the future G? Well, first you have to find the future growth rate, of course. I already mentioned this in the previous video, but it's really important that you get this, and that's why I'm repeating it. So guessing the future growth rate is not easy at all. You need to know the company. You also need to know whether or not it has a moat and it has a good management. So that are the rules from Charlie Munger. And then you have to make an estimate of different things. So you can take the growth rate of the sales, of the earnings, the free cash flow, and the earnings per share. As I said, it's not completely the same as earnings themselves because there is creation or buyback of shares sometimes. So you have to take the average one or take your best guess on what is the best growth rate for the company that you are evaluating. Or of course you can go to Yahoo Finance. So as you know, I'm here on the page of Microsoft. So pre-market trading, it's up already 1%. And when you go to the analysis tab, you see how many analysts are tracking the stock. And then with the growth estimates, you can see what is their estimates of the growth for the company in the coming next years. And currently it's 16.24%, so not bad at all. Companies that grow more than 15% per year are of course great companies. So you can always go to Yahoo Finance and look at the number there, and you have to know and keep in the back of your head that the future growth rate that is written there is never certain, so be careful. Taking your best guess is okay, but you should use a margin of safety. So a minimum of 10%, a maximum of 30%. I wouldn't go that high because maximum of 30%, that's already reducing the future PE rate by a lot. And you are also going to use a margin of safety on the valuation that you are calculating for the stock. So with a minimum of 10% there as well. So when you add those marginal safeties up, then yeah, it's getting harder and harder to find stocks that you can actually buy. So don't go too high here. If you really think the stock is the company is really volatile and really risky, then you can go higher with your margin of safety with your valuation. So when you think the stock is really risky, take a margin of safety of 40% there, and just take a margin of safety of 10% for the stock, its growth rate. So my PE values compared to the PE values that you can calculate from the formulas of the new and the old Graham are then for 0 up to 10% of growth rate are completely the same as the new formula of Graham. So 7 up to 17 with 7 plus G. I think that's more correct for the lower growth rate numbers because it's already with a margin of safety calculated in it. So yeah, I always did it this way since I'm 15 years old, so that's not going to change quite fast. Where I have differences is of course from 11 to 20%. I think this is one of the best ranges to invest into companies. So companies that grow higher than 10%, and most of the time they are then growing around 11 till 15%. So there I add compared to the formula of new Graham. So I start with 7 plus G and then I calculate 11 minus 10. So that's then the growth rate. So 11 minus 10 or 12 minus 10. And I divide that by 2. So here I add a half, here I add 1, here I add 1.5, up to here. So where I add 5. So I go to from 18.5 to 32. So 32, I'm already here with the old formula of Graham. So it's also with a quite nice margin of safety compared to the formula of the old formula of Graham. And then for an even higher growth rate from 21 till 30, and actually also up to 35, there I calculate even with an extra factor. So with the factor that I added from 11 till 20, I add another one, and that's 21 minus 20, or 22 minus 20, 30 minus 20. So then it goes from 34.5 till 57. So much higher than the new formula from Graham, but still lower than the formula of the old Graham. And I just continue it until a growth rate of 35%. So I'm pretty much in the middle between the new and the old formula of Graham, but I'm also not correct. Nobody is. That's really important that you know that. And I never go higher than 35% over 10 years. So, because it's really unlikely to grow for maybe 35% compounded over a period of 10 years, I never calculate with that amount. So I never use higher numbers, and I will never buy companies that are trading with a PE higher than 67. So when I see a company trading with 68, 69, 60, 70 and above, like Nvidia right now, they are trading at a PE ratio close to 80. I'm not considering buying them. It's way too risky for me. The moment that they miss their estimates, they are going to crash like crazy. I have seen it before, and the way Nvidia is going up, it reminds me a lot about how the stocks were going up in 98, 99, just before the dot-com crash. So it goes really fast when those companies start crashing. So companies with high PE ratios, I stay away from them. And of course, when I bought Nvidia early, and it's right now trading at 80, I'm happy with that. So I know that it is a great company, but I already sold it. I already bought it a way, way, way long time ago. When it's then trading at 80, I actually don't care that much. So, and as I said in the first part of the series, valuating stocks is really important, and especially in the selling. So having your sell target in your head is also really important. So how can we apply this? That is for the next video. And with that being said, I thank you for watching this video. I hope you hit that like button as well. It helps out distribute the video to other potential viewers. So I thank you for doing that as well. And see you on the next video on my YouTube channel. Bye.